and welcome to the second episode of Baatein Bazaar and Beyond. Our guest tonight has a slightly different take on all things bazaar, fund management and beyond, be it his reason for joining the fund management industry or his manner of handling stress given the hands-on nature of the job. He's a veteran of the asset management industry with 2 decades of experience and a long-timer at JM Financial Mutual Fund. Please join me in welcoming Mr. Asit Bhandarkar, Senior Fund Manager Equity for JM Financial Mutual Fund. Well, thank you so much, Asit, for joining us today. And thank you so much for taking time out to speak with us.
It's my pleasure.
So let's just dive in.
Sure.
First thing I want to know, what got you interested in fund management in the first place, in the investment industry in the first place?
Wow, that's a good question because I'll have to probably go back maybe almost 3 decades now here. While I was a teen, those were the times when India was going through a tough economic climate. In fact, I remember, India had to almost pledge its gold to get, because we are short of foreign reserves. And then in 91, financial reforms came through. And that was like that magic moment where, government steps aside and, private capital will start owning and growing as a result. And I think that really changed the texture of Indian market. And I was an avid reader of these changes,
Right.
These are like those at that time, Today it's history, but those are current times then. And I realized that capital markets would do well, and I sort of got hooked. Of course, I won't be, it may be very naive, but the Harshad Mehta rally that time in 91 really got me excited with how much wealth can be made.
No, I don't think you're alone in that.
Yeah, it did capture the country's imagination. But yes, I think what happened subsequently, even further strengthened my interest that this is something this can be studied.
Yeah.
This is something where probably a person like me can add value. And I followed up. I was pretty young then, I was in school, but I followed up and ensured that I made this my career.
Wonderful. So tell me, what is a typical day in the life of a fund manager?
I don't know about others, but my day is very simple actually. I start a little early in the morning and I'm a little selfish that time. I keep the early part of the day, maybe an hour, I keep it for myself. So I try and walk or swim. And these are activities where you are in a solitude of sorts.
Right, actually.
It sort of helps me put the whole day in perspective. Sort of plan out a little, go through your thoughts about what you want to do through the day. And post that, once I'm in office, it's a very collaborative mood. You collaborate with your colleagues. In fact, one of the first things that we do, post your initial market opening, etc., whatever things you've planned out for, is that we have a morning meeting where the entire team sits together. And although, each of them are classified as separate sectoral analysts,
Right.
we ensure that everybody sits together because, it's a connected world today. You don't know what affects whom. We have an economist in our team who just told us last week that Turkey's interest rates have gone to 40% and their inflation at 67%.
Right.
We may not believe it, but there is a chemical analyst in my team for whom in some of his companies it's pretty relevant. So that's one of the things that we do. We collaborate, we work together, we take decisions, we interact more with companies, and as we wind down, I guess it's time for some fun, time for family, and some relaxation. So some music, some television in the evening. Why not?
Great. So in your formative years, from the time when you started working, a little before that also, who or what were your major influences?
It's a good question, Akansha. most people would be sort of tempted to talk about some famous personality or quote a book here or there.
Right.
But really, if you ask me, and if I really answer this honestly, I've been influenced by a lot of people that I've worked with. Some of them could be my senior, some of them could be my junior. There's always something to pick up from somebody who is successful and who's a hard worker and who's around you. Believe it or not, I don't have a technical background, so I have actually learned about a lot of businesses, how they function, etc. Even from companies, CFOs, corporates, promoters, who have taken time out to explain things to a novice like me. So yes, I think I have learned a lot of things from a lot of people, and believe me, I can say that Charlie Munger is my hero of sorts as far as the investing philosophy is concerned. But the fact is that when we pick stocks, it's far beyond that. It's not just the philosophy alone, but it's the understanding, it's your ability to envisage how the business will do. And I think a lot of people have had contributions there. So I'll be very unfair if I name one.
Right. But then this is an unfortunate time for you. Charlie Munger just passed away a couple of days back, and Henry Kissinger as well. So
yeah,
we lost stalwarts.
Yes, incidentally, I mean, these were two personalities who I profoundly respected. Henry Kissinger's perspective of history and its its impact on modern day politics is a lesson case study for anybody to follow. And of course, Charlie, I mean, I'm going to miss those great AGMs of Daily Journal. Right. And of course, when Warren Buffett and him sat together at the Berkshire Hathaway AGMs, I think a lot of people would miss that.
I'm sure. So tell me, what is that one habit you think fund managers should inculcate early in their careers, which would help them as they progress?
Yeah. See, I'll tell you, one of the things that I have personally benefited with, is getting down to the brass tacks, getting your hands dirty. I started my career as a pharma analyst, and believe it or not, I don't have any pharma background. I do not have any technical background. But when I passed out, the capital market was going through probably its worst phases post Y2K. And nobody wanted that job, so I took it. Right? But my point is here that if you put enough time on something, nothing is impossible to learn. And I think that is my single advice, if I have to give to anybody, that today the time is very different from the time that we started. Information is available on the online internet. We sort of end up believing that what we read is actually enough. But the fact is, there are certain things that you will learn only when you enter and go to that shop floor of a company, when you go to their premises, when you meet them. And I think that that kind of a depth is definitely required for an active fund manager, because that gives you the pulse. The information part is totally commoditized today. And the kind of hard work and over the period of time, the judgment that you'll build because of that is really invaluable. So, like they say about investing, you should start early. I would say that as a fund manager, you should start early on this part. And this would be the best investment for your career.
Wonderful. They say nothing teaches you like experience. So I think these are all experiences that people should have early in their lives.
Yes.
So, won't say much about performance, that is for everybody to see. But something is going right. There are some change. There have been changes at JM that probably are going right for the asset management company. What are the main changes you would attribute this positivity to?
Yeah, that's an interesting question. See, I'd like to break this question into two parts. One, JM Financial AMC is part of the JM Financial Group, and I have been, associated with this company for a while. And I can tell you one thing, that the group sort of has attributes of trust, of innovation through knowledge, hand-holding the client through tough times, to the journey, etc. And I think those attributes have really not changed. That is what JM stands for, and I think they stand like a corner rock on one side. On the AMC side, you're absolutely right. I mean, life has really changed. I think over the last 3 years, I have witnessed a dramatic change. What we internally call here as version 2.0. I would just draw an analogy to cricket here. This is like the version 2.0 is like the Saurav Ganguly team. Talent was there before it, right? But the confidence with which we are facing the market, the content with which we are facing the market, and the go-getter attitude that we have developed internally, not just in terms of the softer aspects like performance, but also the aggression with which we are facing our investors, our partners, and hand-holding them through this difficult journey of investing.
Right. Wonderful. So, in your significant association with the Indian markets, I'm sure there have been some good moments and there have been some moments where you've learned from. So could you tell us a few of your mistakes, so to say?
See, I think there can be a salacious pleasure with knowing about somebody's mistakes, but I think it's more important to know that what have we done with mistakes, and how have you curated them. See, the approach that I have taken always is that mistakes are inevitable, actually, because see, I am in a job of taking a decision every day, right? Each decision will have a binary outcome. I'll be right or I'll be wrong. There's no middle path. And my success will be less determined whether I am right most of the times, but what I have learned over my career is that my success will be more determined by how early can I catch my mistake and how quickly can I curate it. A dear friend of mine introduced me to the sport of golf. Actually, I'm sorry, I may be digressing here, but it may be relevant. And about a decade back, I started on this with the sport, and the way the sport works is that you have to reduce your mistakes to win, right? That's one mindset change that you bring about. But second, I think the second thing that it teaches you is that when you tee off the first shot that you play on the green, you need a lot of power. But the last shot that you want to play, where you want to put the ball into the hole, that needs featherweight hands and a very soft touch and a lot of judgment. So, and all this is happening in a matter of, say, maybe 5 minutes to 10 minutes on the same hole. So you need flexibility, right? And that's something I learned, and that helps you helps you in the process of investing, because without flexibility to understand what has gone wrong, and without flexibility to identify your situation at a particular point of time, if you're not flexible enough, if you're rigid, then you cannot take the right decision. And third, irrespective of whatever you try, even in golf for that matter, you will end up in the woods or in the water, right? And what's the best thing to do there? You reassess your position.
Absolutely.
And take a step back, and then start playing to your strengths. Collect yourself and start playing to your strengths. And that's something that I've used, actually, that stop procrastinating in life. It doesn't take us anywhere, right? Just pull yourself together and curate your mistake. Find what that mistake is. So internally, within our process, we have a nice mechanism where we try and look at our mistakes and try to capture them early. We have various algorithms that we run, and we try and capture our mistakes quite early. And identifying the mistakes is the first step. Being flexible enough to understand that we have to do something about it, and not only the second step. And the third and most important step is just cure it.
Absolutely.
Right? If there is a problem, there's a solution always. And that has really helped me, to be frank.
Wonderful. Let's come to your investment process, your investment philosophy a bit. Could you tell us a bit about your investment philosophy and how has that evolved? I mean, you've been associated for many years with the with the Indian equity markets. How has your investment philosophy evolved over the years?
See, at the core, I am a growth investor.
Right.
And, I'm really fortunate that I am in this country at this time because, there is growth here. And I think that sort of counts as luck. But over my career, I have realized that blind focus on growth may not protect you from accidents. When you grow fast, like you drive a car fast, there can be accidents. It's fun. The journey is really fun, but there can be accidents. So as a manager, the way the process has evolved is that how do we bring in checks and balances where we enjoy these fruits of growth without, getting into these problems that may occur because of the accidents. And, we have put in good quality parameters there. And I think, this is the only way you can prevent that you control what you buy by a quality filter. And internally we named it the geek philosophy. And what it really tries to do is that put a quality filter on top of our growth expectations so that we achieve superior risk adjusted returns. The returns at any cost may not work out in a black swan event.
In the long run.
So that we try to calibrate that. And I think that to my mind has come as I have evolved.
Okay. All right. So let's break up the process a bit. Let's talk about new idea generation. How does that work? What is the dependence on the sell side? Does it get originated within the team or what is the role of the sell side there? All this kind of. Basically, how do you zero in on an idea?
So you want to know the secrets? Huh?
Absolutely. And for the world to know.
but Akansha, see, I'll tell you, nobody has a patent over the next best idea.
That's
right. True. I mean, we don't know where the inspiration can come from. It can be from a newspaper, it can be from something that we see, it can be from some report that we read, it can be from event, right? So what we do, and I think this, we have institutionalized sort of as a team, that we have a funnel of sorts, where any of these ideas that, we like for, so we just record it internally, for what reason, why, etc., etc. And then the real grunt work on it takes, where the process takes over. And the feeling gets converted into analysis, and the analysis then eventually probably will get converted into a decision.
True. So once an idea is zeroed on, what is the process from there to it becoming part of your portfolio? I understand that mandate will play a role, mandate of the portfolio, but within that, how is it that it goes from your investment universe to the size of the position that you ultimately take in a portfolio?
Well, this is where it stops being a science and becomes an art, actually. So there's no one answer to it, As I said, our basic focus for every portfolio is the risk-adjusted return. Like you said, mandate will determine the risk. Yes, sometimes we distinguish the portfolios a little more differently than what, say, the regulator may be looking at. Regulator may be looking at all equity portfolios in a similar way. But we do know that a flexi-cap fund will have a different profile and will need to be a little different when we're looking at that portfolio than, say, a value fund, right? So we do that, and both these funds probably would have the same benchmark, right? So we when we look at a stock, we have we try and think together which portfolios this particular stock can be curated, and you can put into that particular portfolio. Will it fit there? Will it grow there? A particular mandate may be okay with the stock being curated for a longer time. A particular mandate like Flexi may not have that much time for curation. So all these parts, we discuss amongst ourselves, and we decide what's the right place for a particular stock within our universe of funds, and then how to size it.
Right.
When we are seeing a near opportunity, very strong opportunity which needs to be captured, our sizing will be significantly higher. However, if we feel that this is a longer term opportunity and the story will have to be curated over a longer period of time, we'll start with smaller positions and build up as the story becomes stronger.
Right.
Because at the end of the day, over a longer term, most stocks that we pick may end up doing very well, but we have to balance out the long term with the shorter term, and we have to bring in an element of consistency. And that, I think, is the single biggest thing that determines our sizing within a portfolio and the selection of stock within a particular portfolio as well.
So, can you also give us a sense of your sell discipline?
That's a good question. See, I'll tell you, there are two or three reasons why we sell a stock. One, obviously, if there is some corporate governance issue, integrity related issue with the management, some changes that we didn't expect, then it's a philosophical thing we have to just get out.
Right.
Then profit loss timing may not matter much.
So much, yeah.
Second, when the performance of the stock deteriorates, the company does not deliver, or there's a massive change in what we expected versus what is being delivered, then we sell off. And these are, I think, I would think these are easy decisions. What is more complex is where the stock is there in our portfolio, it's doing nothing wrong, okay, but insidiously it is leaking our performance. So there, we have to wear the portfolio manager's hat. Everything regarding the stock may be fine, but it may just not be performing like the rest of the stocks in the portfolio.
I get your
so
point, yeah.
For no fault of that stock, it may be out of the portfolio.
Right.
So we consider all these things, and that's how we take our decisions on the sell side.
Okay, you are an active fund manager. From your perspective, what does the active versus passive debate look like? Where do you stand there? Is that even worth debating? Do you think there are different roles for active funds and passive funds in an investor's portfolio?
No, Akansha, it's a relevant debate. It may not look so relevant today. Maybe 2 years back, it was a very relevant debate, or these times will keep changing. But the fact is that passives are a low-cost low-cost option for an investor who knows where to put money. Right. Second, who has a very long-term objective. So, but where the actives play and where I think they become very relevant in a country like India, is that when I look at some of the passives, they are mostly based on very well diversified indices. And when I look at, say, for example, now when I look at the economy, our economy is significantly tilted towards services, but industrials is say a fifth of the economy. But when I look at some of the indices, I don't see the representation there. Right? We all know that this is a young population, it's going to get old, but I don't see enough representation for healthcare infrastructure, for example. Right? So there are a lot of sectors which are very high growth sectors, which have in developed markets generated a lot of wealth for investors, say retail, for example.
Right.
There is hardly any representation. So there are a lot of such sectors which get underrepresented in the indices, and hence to that extent, I guess, they undermine the potential of a passive investor, what money he can make. Whereas in the active funds, we have that option to size these ideas, curate them. They may be small today, but what I've seen is the real money is made from the journey where the stock goes from being a small cap to a mid cap to a large cap, right? And that eventually will lead to a higher weightage, but we in the active side try to capture that first, and hence we generate that alpha.
Right. That's a very logical take on that. Okay. So when we talk to fund managers, it seems like there's a lot of reading, there's a lot of analysis, there's a lot of meeting companies, all of that to be done. Sounds like a handful. How do you manage your stress?
Well, I think the easiest way to manage stress is not get stressed at all, right?
Okay,
See,
yeah.
I think if you're very organized and you know where you're going, I think it's not a easy thing. See, things go wrong in our lives, right? It's always prudent that we reassess our situation right then and calibrate our actions.
Right.
So if you have a backup plan and you can react positively to the stress, then it's not really stress. I try most of the times to do that, and I hope I'm successful with that.
No, I'm sure you
I
are.
don't know. Do you see me very stressed in the office?
Oh, never.
Exactly. Well, to me, that's a compliment. Thank you.
No, but I'm exceedingly stressed all the time. So it's very, actually, it's a welcome change to see people not stressed with this kind of hands-on kind of profiles. The economy is growing. So many sectors are growing. But, we shouldn't miss out on our own industry. We've also grown by leaps and bounds.
Yes.
But how do you see it 5 years hence? What is your vision for this industry?
See, Akansha, we just, last year crossed $2,000 per capita
Right.
GDP. And what we've learned from, other countries that have crossed similar barriers in the past and larger countries of our size is that the financial assets and the financial savings will increase, right? And that the pool that this industry will manage will go up dramatically. From the investor side, I think investor will get more and more sophisticated. He'll need more and more choices.
Right.
There will be those class of investors who will want to take more risk. There will be those class of investors, like you mentioned in your earlier question, who will want the simplicity of the passives, all that. And most importantly, we are a very large country. There will be, there will be those businesses which will just survive because of their reach, because their ability to reach a particular community, So if you see, I won't be surprised if, in the next 20 years, this business grows further. And I was just reading that, there are some 400 AMCs in China.
Okay.
Right? So that just tells you that sometimes I'm not saying it will happen here, but it's set to grow from here for sure.
No, but the kind of penetration that is needed, we may require 400 AMCs.
Yeah, I think, as I said, investors get sophisticated, needs change. So there will be those, those companies which will be large, they will be catering to everyone. There will be those who will have specialized niches. Investors will get more and more sophisticated. Who knows, an Indian investor may want to invest globally in a far more diversified manner than the choices available right now. Right? So those things will change, and there will be those people and there will be those businesses which will capture some of these trends first, and they will have an early mover advantage, right?
Absolutely.
I mean, we have seen what's happening in auto today. Largest companies having the best R&D, they are today getting challenged because somebody has decided to sell cars with batteries.
Right.
And, it's turning the whole thing upside down. So disruption will happen. People's needs will change. But one thing is for sure, that the GDP of this country will grow. The financial assets that people will own will continue to grow. And the need for a good manager will only be stronger.
Absolutely. I'm into that. And now, on a final note, what is that thought you would want to leave your investors with, as they approach 2024 or in their general investing journey?
Sure. So I think 2024 is going to be an interesting time. We have a general election coming up. Like I earlier mentioned, that a lot of volatility was expected in 2023. It didn't happen. Who knows? It may happen in 2024, right? So and we've had a very sharp rally with small and mid caps right now. I would think that investors should look at their asset allocation closely. They should rebalance their portfolios. This is a good time to do that, and be prepared for a little bit of volatility. It may not come, the country is doing really well, things look quite fine from here, but I would definitely think being disciplined, being more balanced will always serve an investor far better in the long run.
Absolutely.
We've always known that markets are all about greed and fear,
Right.
maybe we are a little tilted on the greed side right now, and who knows when the fear comes, right? If you're on the right side, there are great opportunities.
Absolutely. Absolutely. Asit, it was a pleasure talking to you. I had a wonderful time, and thank you so much again for, taking time out to speak with us.
Yeah, Kansha, very thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.